It seems that good economic news out of China is now translating to bad news for the markets, perhaps on lesser expectation for more easing and stimulus. What do you think?
Yeah, absolutely. I mean, I would still say that, the good news is out of China is what the markets really need at this point where, globally we are seeing these inflation concerns not dying out as was perhaps expected by the markets towards the end of 2022 or early 2023. So the only saving grace for the markets really is coming out of China, even if it means more easing, more, potentially more policy measures to support those industries that have really been beaten down over the last 3 years, mostly, of course, consumption, but also looking at the property sector as well as the internet companies in China. All of those need a lot more support. And what that means for the market, yeah, it might be, a little bit of pressure for the markets, but we are coming from a valuation where these equity markets in China and some of the other Asian countries as well, which are more dependent on China, have been beaten down so much over the past few years that just this, resurgence of activity levels kind of obviously brings back a lot of interest in these Chinese markets.
Charu, how much of that good economic news in China is going to be inflationary for the world?
Yeah, that is something I'm quite concerned about, because as we just touched upon, the disinflation rhetoric that had started to kick in has obviously been thrashed again once more. And Saxo has been saying this, since last year, I think even more than that inflation is here to stay. Inflation is going to be high for longer. Now, that obviously is underpinned more structurally by the mismatch in the labor demand and supply that we have globally. But the China reopening story adds a cyclical upside pressure as well because of the sheer amount of demand that China can create for commodities in particular. Tourism demand also, I think that's something that we are looking at a big uptick there, and that can of course feed into inflationary pressures as well. And even from a structural standpoint, China's population going down does mean that these labor supply issues for the whole of the world will still continue. So I think the China story is a big factor that will continue to play into our inflation expectations.
And how does that play into your investment decisions, right? What are you liking at the moment if you're looking at things as an inflation hedge, if you're looking at things that have that exposure to the roaring back of the Chinese economy and the Chinese consumer?
Great. That's a great question and a pretty broad one. So let me touch upon as much as possible. So first thing, when you're trying to hedge your portfolios against inflation, it is obviously important to keep a very balanced portfolio, add some, inflation-protected bonds to it, something of that sort. But if you are obviously more focused on getting exposure to that China reopening story, there is obviously interest in Chinese and Hong Kong stocks. As we said, there's a lot of interest coming in Asian tourism stocks as well, because as China outbound tourism picks up, we are potentially thinking that Asian tourism and hospitality sectors will be the first few to benefit because the number of flights to the West are still pretty limited. The other very interesting piece of this puzzle here is the European stocks. And, many investors, specifically in Asia, are still not investing enough in European markets, which obviously present an inflationary environment. You have a value-rich companies plus more tailwinds from China reopening as well.